All right, we're going to dive into a pretty provocative idea from our source material today, and it's this. What if the banking system isn't really set up to make you rich? What if it's designed to keep you, well, dependent? Let's take a look.
So think about this for a second. You go to the bank, you deposit $1,000. Feels good, right? You figure it's safe in there, maybe earning a little bit of interest. But have you ever stopped to ask where that money actually goes? Like the moment it's not in your hands anymore?
Because here's the first big secret according to our source. Your money is definitely not just sitting in some high-tech vault with your name on it. Nope. The second you hand it over, the bank puts it to work for them. We're talking loans, investments, and generating profits that chances are you'll never get a piece of.
Which brings us right to our first big question. What is happening to your money? And more importantly, why is your savings account maybe not the safe little nest egg you thought it was?
Now, this is going to sound a little nuts, but our source makes a really bold claim here. They say that keeping your money in a regular old savings account might actually be making you poorer every single day. And it all comes down to a battle between the tiny bit of interest you earn and this powerful, invisible force. Let's break down the math based on this example. So, you put in your $1,000. The bank, being generous, gives you 0.5% in interest. That's a whole $5 for the year. But if inflation is humming along at 3%, the actual buying power of your money just shrank by $30. So yeah, your statement says you have more money, but in reality, you've lost $25 worth of what you can actually do with it. But that's not even the wildest part. That's just what happens when your money sits still. What banks do with it? That's where things get really interesting. Our source claims that banks don't just hold money, they actually create it. And the engine that makes this all possible is something called fractional reserve banking. Now, it sounds super technical, but stick with me, the idea is actually pretty simple. It just means banks only have to keep a small piece, a fraction, of your money on hand. And the rest? Well, they get to lend it out. So, here's how it plays out. You deposit your $1,000, right? Your account says you have $1,000. But the bank only keeps, say, 100 of that. It then loans out the other 900 to someone else. Now, you still have your $1,000, but that borrower also has $900. Poof! Your one deposit just became $1,900 in the economy. And guess who gets to charge interest on that brand new money? The bank. And if you think that's where it stops, think again. The source warns that it gets even riskier. Banks aren't just making simple home loans with your money. They're also investing it, sometimes in incredibly complex and, let's say, dicey ways. The source points straight to the 2008 financial crisis as the perfect example of what can happen when those big gambles with your deposits go belly up. Okay, so all of this is really pointing to one main thing. When you boil it all down, the real business of banking, according to our source, isn't about keeping your savings safe, it's about one thing, the business of debt. Let's see how that model really works. You know, the heart of the whole operation is this absolutely massive gap. Check it out. The bank might pay you 0.5% on the money you saved with them, but then they turn around and charge you 20% or even more on your credit card. That enormous spread, well, that's their profit margin. In fact, the source goes so far as to call credit cards the bank's secret weapon. They argue that credit cards were never really designed for your convenience. They're designed to get you stuck. The bank makes a little money when you pay your bill on time, sure, but they make a fortune when you're trapped making those high-interest minimum payments month after month, year after year. And it's not just interest rates. Just look at this number, $30 billion. According to the source, that's what US banks rake in every single year just from overdraft fees. Think about that. That's a penalty charge to people who literally have no money, which is basically like a tiny loan with a crazy high interest rate. And the scale gets even more staggering when you look at the big stuff. Take a mortgage. That monthly payment on a $300,000 house might seem doable. But our source claims that by the time you've made that last payment 30 years later, you could have handed the bank nearly $600,000. Almost 300 grand of that is pure interest. So here's the key question. Does this system work the same for everybody? The source says, not even close. And this next part, this highlights what it calls the biggest divide of all. How the system treats the wealthy versus, well, everyone else. And here's the core of the argument. For most of us, debt is a burden. We borrow at high interest rates for things that lose value over time, like a new car or a TV. But for the wealthy, the source claims, debt isn't a burden at all. It's a tool. They get to borrow at super low rates to buy assets that actually grow in value, like businesses or real estate.
So here's the playbook that our source lays out. Step 1, borrow money cheaply. Step 2, use that money to buy assets. Then, and this is the genius part, they let inflation, the very same force that eats away at your savings, actually increase the value of their assets while shrinking the real value of their debt. They can even borrow against those assets for cash so they never have to sell and pay taxes. It's a different game entirely.
So what's the end result of all this? The source has a pretty stark name for it: a tax on poverty. Think about it. From payday loans to check cashing fees to sky-high credit card rates, it's the people with the least amount of money who end up paying the most, percentage-wise, for basic financial services. Meanwhile, the wealthy are getting the best deals and rewards.
Okay, so this brings us to the final and maybe the most crucial piece of the puzzle. If the system is really set up this way, what on earth is holding it all together? And how do you learn to play their game instead of just being a pawn in it?
I mean, why doesn't everybody know these rules? How does this whole complicated machine just keep on running so smoothly, day in and day out? Well, our source argues that it all rests on two fundamental and kinda shockingly simple pillars.
The first pillar? A widespread lack of financial education. The source claims that if people don't really understand how things like compound interest on debt actually work, it's way easier for them to get trapped. And the second pillar is our own unquestioning trust in the system itself. And that really gets to the heart of it. The source says all those giant buildings, the marble floors, it's all there to create an image of stability. But underneath it all, the entire system is built on one very fragile thing: your trust. As long as we all believe our money is safe, it works. The second that trust gets shaken, the whole thing can start to wobble. So what's the big takeaway here? According to the source, the point of all this isn't to make you afraid of banks or to tell you to hide your money under the mattress. It's about something much more powerful: empowerment. It's about finally understanding the rules of the game so that you can play it to your own advantage instead of just being played by it. Which really just leaves us with one last big question. Now that you've had a peek behind the curtain, now that you know a few of the rules, how are you going to play the game?